Morning everyone and welcome back to Morning Markets from True Potential. Yesterday equity markets were relatively quiet, taking a pause for breath after a pickup of volatility in recent weeks. In Europe and in the UK they traded flat, whilst in the US the two main markets, the S&P 500 and the Nasdaq, traded a little bit lower, down 0.4%, and overnight Japan was also down 0.4%. The big event yesterday was the US inflation report. There are two measures of inflation really to focus on: the headline consumer price inflation, CPI, and core consumer price inflation, which excludes volatile items such as energy and food. Both readings surprised to the upside, a trend which we've seen over the past couple of months. US headline CPI rose 0.9% month on month in June after recording a 0.6% gain in May and well ahead of the forecast 0.5%. Looking at core CPI, remember that strips out volatile items such as energy and food, that also came in at 0.9% over the month against the 0.4% which was forecasted. If we look at the year-on-year numbers, core inflation came at 4.5%, its highest reading since 1991, and well above the US central bank's target rate, which is an average 2%. Whilst if we look at the headline consumer price inflation year on year, that came in at 5.4%. And we can see that from the chart. What is important is really to dig into the underlying components to get a sense of whether the inflation is driven by areas which have been more impacted by the global supply chain issues, which can be relatively short-lived, or whether it's due to more structural areas that could be more persistent, such as rents. As we can see by the chart, the vehicle-related component which contributed significantly, again, a similar trend to what we saw over the past couple of months, with used car price increases rising over 10.5% over the month and new vehicle prices up 2%, with consumers with a lot of cash in their pockets while production is being constrained by global supply issues. Energy was also a big contributor to the headline CPI level, with oil prices rising materially over the month. If we look at rents, which account for almost a third of the overall basket, it did show an increase of 0.5% over the month and now 2.6% year on year, which will be really important to see whether this component becomes entrenched in future readings. The Federal Reserve's mandate is to achieve inflation at an average rate of 2% whilst maximising employment. A significant rise in underlying inflation has tended to see the Federal Reserve to raise interest rates. The central bank has said in recent months that the current inflation dynamic caused by the COVID pandemic will be transitory, and therefore are not expecting to have to raise interest rates until 2023. If we continue to see higher than expected inflation in the coming months, this forecast will certainly be tested. The response from the bond market was an initial spike in US government bond yields up to 1.38% before dropping back down to 1.33%. Bond yields did rise again later on in the afternoon up to 1.42%, which coincided with an auction of US government bond yields, government bonds with a 30-year maturity. Since then, we've seen bond yields actually come in a little bit, so they're currently trading at 1.39%. This morning, we also had UK inflation, where both core CPI and headline CPI came in above expectations, which was 2%. So core CPI came in at 2.3%, whilst the headline rate came in at 2.5%. In currency markets, the pound was a little bit stronger against the dollar, up at 139, and against the euro, it's relatively stable at 1.17. That's it for today. Thank you all for listening, and we'll see you tomorrow.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.